$300 billion.
Yeah.
You know, we toss around numbers like billions and trillions on this show pretty casually.
Yeah, you almost get numb to them.
You really do.
Yeah.
But when you apply that number 300 billion to a market that, I mean, it practically didn't exist a few years ago, that stops being just a statistic.
Yeah.
That starts to feel like a siren.
It's a vertical line. I was looking at the charts just this morning, and if you zoom out, it almost looks like a glitch in the data.
Right.
We're talking about a market that went from, what, 7 billion to 300 billion in just 36 months.
36 months.
That is not normal organic growth. That's a structural break in how money works.
Exactly. And, well, that's the whole premise for today's deep dive. We are unpacking what the sources are calling the $300 billion signal. We're looking at the stablecoin market, specifically the dominance of things like USDC and Tether, and this whole concept of stablecoin sovereignty.
Right.
And I want to clear from the start, we are not talking about crypto trading today.
No, and frankly, if you're listening to this thinking it's about, pumping some meme coin, you're in the wrong place.
Yeah.
This is about the plumbing. The actual plumbing of the global financial system. The sources we've pulled, they're arguing that while the world was distracted by all the price volatility, a new parallel banking rail was built pretty much overnight.
A rail that's now handling transaction volumes that are starting to rival like major credit card networks. It's kind of wild. The core thesis here is just fascinating. These assets have gone from being casino chips to what the research calls the new Swiss bank account.
It's a loaded term.
It is, and we're going to get into why. Why traditional banks completely miss this, why companies like Stripe and Visa are betting the farm on it, and the geopolitical side of private companies basically printing their own digital dollars.
It's an infrastructure story. While banks were busy optimizing, their legacy COBOL systems and worrying about closing branches, tech giants saw a way to just bypass the entire correspondent banking network.
And now that we're at 300 billion.
Now the experiment phase is over. This is systemic now.
So let's get into the mechanics of this explosion. You mentioned the jump, 7 to 300 billion. That's a 40x increase in 3 years.
40 times.
Now, normally, when I see a chart that looks like that, my bubble detector starts screaming.
Oh, absolutely. It looks like a classic hype cycle.
But the data here suggests something much, much stickier, doesn't it?
It is stickier, and here's why the bubble comparison kind of fails. Bubbles pop when the speculation ends.
Okay.
In this case, the speculation did cool down. We had that old crypto winter. But the stablecoin supply, it just kept growing, or at least it held its ground.
So that tells you the utility changed.
The use case flipped.
Exactly.
In 2020, you held stablecoins to go buy Bitcoin.
And today?
Today, you hold stablecoins to hold dollars.
It's a destination, not a bridge.
Precisely. It shifted from a transactional tool to a store of value. But here's the thing that really stood out to me in the reports. This is not a fragmented market. You'd think with $300 billion on the table, you'd have, 50 different banks and startups all fighting for a piece.
But we don't. We have a duopoly that would make Standard Oil blush.
I mean, the numbers are just wild. Circle, which issues USDC, and Tether, which issues USDT, they control 94% of the entire market.
94%.
It's total domination. And we need to unpack why that happened, because it brings us to this idea of the liquidity moat.
Okay, the liquidity moat.
It's a term the source material uses a lot.
It's a network effect on steroids, right?
Yeah.
I mean, just think about it from a merchant's perspective. If I'm setting up a payment gateway in Singapore, I don't really care about your fancy new algorithmic stablecoin with a cute logo. I just care about what my customers are actually holding.
And more importantly, you care about what you can easily sell without losing money. Liquidity begets liquidity. You go look at the order books on the biggest exchanges in the world: Binance, Coinbase, Kraken. The deepest trading pairs are all against Tether or USDC.
So if I try to launch a competitor now,
you are fighting against billions of dollars of pure inertia.
It's all about slippage, right? If I try to sell $1 million of some brand new stablecoin, the price crashes because there are no buyers.
Yep.
But if I sell $1 million USDC, the market doesn't even blink.
Exactly. That stability, that market depth, that is the product. So Circle and Tether, they've built this moat not just with technology, but with market depth.
So a bank like JP Morgan can't just launch JPM coin and expect everyone to switch over.
It's almost impossible. The plumbing, the exchanges, the wallets, the DeFi protocols, it's all already hardwired for the duopoly.
Which effectively creates a tech monopoly on the dollar itself.
Yeah.
But this is where the story pivots. Because if this were just about traders needing liquidity,
You could dismiss it.
you could dismiss it as a niche finance thing. But the sources all point to this massive BD pivot. This is where the adults enter the room.
The quiet pivot. I love that term from the reports.
Me too.
It refers to that moment when companies like PayPal and Stripe and Visa, when they stopped looking at stablecoins as a crypto thing.
And started treating them as a what?
As a settlement thing.
And this is so crucial for listeners to get. This is not about buying your coffee with Bitcoin. This is about back-end infrastructure.
It is. The reports talk about what Stripe saw that banks didn't.
So break that down. What did they see?
Well, let's just look at the mechanics. If you're Stripe and you're processing payments for a software developer in, say, Lagos, who's selling code to a company in San Francisco, the traditional banking rails are they're a nightmare. You're dealing with SWIFT, with correspondent banks, with T+2 or T+3 settlement times.
And the pre-funding. Don't forget that part. That's the hidden killer.
Oh, absolutely. Stripe has to keep millions of dollars just sitting in local bank accounts all over the world to manage liquidity.
Because moving the money takes days.
It's dead capital. It's just massive capital inefficiency. What Stripe saw was that stablecoins offer atomic settlement, T+0. The moment the transaction happens, the value moves. It settles in seconds, 247, for a fraction of a cent.
So for Visa and Stripe, getting into stablecoins wasn't some ideological stance. They're not crypto bros.
Not at all. It was a pure margin play.
Pure efficiency.
It's like switching from sending physical mail to sending an email. You don't do it because you love the internet protocol. You do it because it's faster and cheaper.
And the source material is clear that this has moved beyond just an experiment.
Oh, way beyond. When Visa integrates USDC settlement on Solana, which they have done, that is them admitting that for certain use cases, the blockchain rail is just superior to the legacy banking rail.
It's the back-endification of crypto.
That's a great way to put it.
The end user might not even know they're using stablecoins. They just know the money arrived instantly.
And that's the Trojan horse. But now we have to talk about the consumer side, because this is where the signal gets really loud for the average person.
Right.
We've talked about B2B, but the source makes a very provocative claim. Stablecoins are the new Swiss bank account.
I gotta say, I have mixed feelings about that branding. Swiss bank account makes me think of, secrecy, prestige, safety.
Sure, but the source is focusing on one metric above all others. Yield.
The interest rate.
It is the single biggest driver of adoption right now. Let's just do the math.
Okay.
If you leave your cash in a standard checking account at a major U.S. bank, or worse, a bank in Europe or Asia, what are you getting?
In the U.S., maybe 0.01%.
Maybe.
In Europe, you might be paying negative rates. You are literally paying the bank to hold your money while inflation just eats it alive.
Right. Now look at the stablecoin market. Through different protocols or even directly from some platforms, you are seeing yields of 4 to 8%.
8%. I mean, okay, but we have to explain the mechanics of that, because otherwise it just sounds like a Ponzi scheme.
Of course.
Where does that 5% come from? Money doesn't just appear out of thin air.
No, and the answer is actually very, very boring, which is a good thing.
Okay.
The big regulated stablecoin issuers like Circle, they hold U.S. treasuries to back their tokens. And U.S. treasuries right now are paying around 5%.
So wait, in a traditional bank, the bank takes my money, buys those same treasuries at 5%, gives me 0.01%, and then they use the other 4.99% spread to pay for their marble lobbies, their thousands of branches, and their old servers.
Exactly. It's overhead arbitrage. Stablecoin issuers and the DeFi platforms built on top of them. They run on code, they don't have branches, they don't have armies of tellers.
So they can pass that yield back to the user?
They can compress that spread, yeah.
But here's the rub, and I think we have to be responsible here. Swiss bank account is usually insured.
A very important point.
If Circle fails, or some smart contract gets hacked, there's no FDIC coming to save you.
That is the critical distinction. This is a risk-on savings account. You are taking on platform risk, issuer risk.
In exchange for that yield.
Right. And the market, that $300 billion market, is effectively saying, we will take that bet.
Especially if you live outside the U.S. I think this is the part we in the West often miss.
Big time.
If I'm in Argentina or Turkey, and my local currency is inflating by 50% a year, holding a digital dollar that yields 0% is a miracle.
It's a lifesaver.
A digital dollar yielding 5%, that's life-changing.
And that's the sovereignty part of this whole discussion. It allows anyone with a smartphone to just opt out of their local broken financial system and opt into the US dollar economy.
It's the democratization of access to the world's reserve currency,
It is.
which leads us right into the conflict zone. Because if everyone is opting into private digital dollars and opting out of the traditional system, where's the government in all this? We've spent years now hearing about the digital dollar, the Fed's CBDC.
A central bank digital currency.
Right. And the source material is it's brutal on this point. It calls it CBDC defeat.
It calls the race over.
Yeah.
And, I tend to agree with that assessment. While the Federal Reserve and the ECB were writing white papers, forming committees, debating the ethics of privacy,
The private sector just went and shipped the code.
they just built it. It's the classic innovation gap. Circle and Tether iterated. They built the integrations with Stripe. They got the liquidity.
And now if you look at the landscape, why would the U.S. government even launch a consumer-facing CBDC?
It would be a nightmare for them. They'd have to handle customer service, privacy concerns, KYC for 300 million people.
And frankly, do you think the American public wants the Federal Reserve to have a direct line into their checking account?
It feels like a total privacy non-starter.
I think so too.
So the argument is that the private sector has won this digital dollar war by default. The U.S. government will most likely just end up regulating these private issuers.
Treating them like narrow banks or something?
Exactly. Regulating them heavily rather than trying to compete with them.
So the future isn't some Fed coin. The future is USDC, heavily regulated, backed by T-bills, but running on public blockchains.
That seems to be the equilibrium we're heading toward. The government controls the asset, the dollar, but the private sector controls the rails.
Which is a profound shift. We are, in effect, privatizing the movement of money.
We are. And that brings us to the outlook. The source calls it the 2026 playbook. We're at $300 billion. They're eyeing the next $700 billion.
$1 trillion market cap. That's the big psychological barrier.
Right. Once you hit $1 trillion, you're not a niche asset anymore. You are too big to ban. You are systemically important.
And the argument is that the next leg of growth won't come from crypto traders.
No, it's going to come from plain old commerce.
It's the normalization phase. It's when your Uber ride, your coffee, your B2B invoice,
Yeah.
they're all settled in stablecoins, but the app interface just says $15.
Exactly. The tech just fades into the background. So the playbook for 2026, for anyone listening, is really to stop thinking of this as investing in crypto.
Right.
You don't invest in stablecoins. The price doesn't go up. You use them to optimize your business or your personal savings.
Yeah, if you're a CFO, you should be looking at this for cross-border payments to cut costs if you're an individual.
You look at that yield differential and you monitor the regulatory landscape very, very closely. Because as we get closer to that $1 trillion mark, the banks are going to wake up. They are not going to let their deposit base just bleed out to Circle without a massive fight.
That is the big unknown, isn't it? Banks lobby hard. I want to close on this thought about power dynamics. We title this Stablecoin Sovereignty.
Which is a heavy concept.
It is. If private companies control the rails of the digital dollar, and they offer better yields than banks because they're more efficient, and they move money faster than SWIFT, haven't they effectively become more powerful than the traditional institutions we've relied on for a century?
We are absolutely watching a transfer of power. For the last 100 years, banks were the gatekeepers.
Right.
If you wanted to participate in the economy, you needed their permission. Stablecoins are shifting that power from institutions to code.
So it's a separation of money and banks, not necessarily money and state, because the dollar is still the underlying asset.
Exactly. But that commercial banking layer is being disintermediated.
And that is terrifying for the banks. If that $300 billion grows to $1 trillion, that is $1 trillion of deposits that are not on bank balance sheets to be lent out.
And that changes the entire fractional reserve model.
It forces banks to actually compete for our capital again. Imagine that.
What a concept.
The $300 billion signal isn't just about a new asset class. It feels like a wake-up call to the entire financial industry, that the plumbing is being ripped out and replaced.
And for you, the listener, the takeaway is pretty simple. The migration has started. It's a quiet migration from 0.01% to 5%, and from 3 business days to 3 seconds.
And usually, in tech, the faster, cheaper, more efficient solution wins. The only question is how bumpy the transition is going to get.
Oh, it'll be bumpy. The next $700 billion will be a wild ride.
We'll be watching every billion of it. Thanks for helping us break this down. It really does feel like we're looking at a blueprint for the next decade of money.
My pleasure. It's a fascinating time to be watching the charts.
And to everyone listening, check your yields, watch the rails, and remember, innovation rarely asks for permission. We'll see you on the next deep dive.